our second CVWD meeting today. We met previously with Crescenta Valley Water District, who is a new client for us. And so we are calling them the other CVWD. So it's a pleasure to be able to meet with the original CVWD this afternoon, and Jason Schmidt, who is our Deputy Chief Investment Officer and Lead Portfolio Manager for the district, will be reviewing the quarterly results and also provide an update on the economy. Thank you very much, Jason.
Great. And so I'm going to share my screen if that's okay with everybody. And want to ensure that everybody can see my screen.
Yes.
Great, great, great. And so as Mia said before, we're going to talk a little bit about the economy, see how that relates to the portfolio, and then open it up for any questions that the committee may have. And so just going to start off here with a brief summary of what's been going on. As always, during the pandemic, it's been very exciting to see what's going on as far as vaccines and things like that. The vaccine rollout started off slow, but definitely it picked up pace throughout the beginning of the year. In addition to that, we have the Biden administration also, including additional stimulus into the economy. About $5.6 trillion has been placed into the economy or has been passed to that extent as in the last 12 months in order to really help the economy. Remember that we are technically still in a recession. I would think that we would be pulling out of the recession, and the National Bureau of Economics is likely, I would think, towards the late part of the year, maybe to tell us that we are technically out of a recession, just because all the different numbers are really geared towards being more positive. We are now seeing estimates for gross domestic product, and I'll show you a graph a little bit later, of north of 6%, actually right now around 6.2% for GDP growth. That would be some of the best GDP growth for any given year, probably since the early 80s, after we came off of that very deep recession that we had kind of in the Reagan era. And so from that perspective, we are expecting that the economy will continue to grow. And a lot of that has to do with the increased vaccinations. And so as many of us have started to get those vaccinations, we have also started to see the easing of restrictions from local authorities. And with that, some of those hardest hit industries, such as restaurants, travel and leisure, and things like that, are going to start to have more of a recovery than they have had in the past and 12 months. And so we will continue to watch that as that continues to roll forward. But again, the expectation is that here in the US, we will start to see some continued pretty rapid growth in 2021. With that backdrop, the Federal Reserve, as it relates to your portfolio, because the Federal Reserve has a lot of influence over interest rates, continues to have a very accommodative monetary policy, purchasing about $80 billion per month of US Treasuries and around $40 billion a month of mortgage securities, for a total of about $120 billion per month. Remember that there's a lot of deficit spending that is going on today as far as the federal government is concerned. And with that, the Federal Reserve is helping the markets continue to be very liquid and fluid for these types of debt issuances to come into the market. The Federal Reserve is also talking about its inflation rate. Before, they used to talk about an inflation target of 2%. Anytime that it would go over 2%, potentially they would take action. They are now talking about an average of 2%. They haven't told us exactly what that means as far as the duration of that average, but we do think that what we can take from that is that inflation may go over that 2%, whether you look at PCE, personal consumption expenditures, which is the Fed's most preferred measure, or CPI, Consumer Price Index. And we are starting to see that now. And actually the March numbers actually may, on a year-over-year basis, point us towards some of the steepest increases in those inflationary numbers. A lot of that has to do is we are coming off of the very lowest numbers too. Remember March of 2020 and things like that in April were some of the lowest numbers that we saw as far as in this economic cycle. And that's, we entered the recession potentially back in March and April of last year. There continues to be some supply chain issues. I know that many of you have heard about semiconductors as far as maybe potentially not having enough semiconductors for autos. Also, that relates back to tractors. We heard from Caterpillar the other day that it might have to, not supply as many tractors out there because it doesn't have enough semiconductors. But it also goes across the spectrum. Copper prices have been increasing. I don't know if you've gone to go pick up a 2x4 at Home Depot more recently, but the cost of that has also gone higher too. That really has to do with supply chain constraints. As we went through the pandemic, we had to shut down factories and things like that. And also as we went through the pandemic, especially here in the United States, consumers were purchasing more goods rather than services. That potentially could flip moving forward, which would actually help the supply chain issues. But definitely we are going to continue to see these probably throughout the remainder of the year. And what that does is essentially put potentially upward pressure on prices of those particular commodities. If you look at the yield curve steepened. And what do I mean by that? And I'll show you that a little bit later. But shorter term rates have remained relatively the same. And as you go further out the yield curve, 5-year, 10-year, maybe even 30-year bonds, you've seen that those bonds have actually increased as far as the yields there. And so we call that as a steepening yield curve. And that also does present some opportunities for the portfolio as far as buying some longer term securities, being able to garner higher interest rates than you can get on very short term securities. So I'll show you that a little later in the presentation. This is looking at employment. And so on your left-hand side here is what we call non-farm payrolls. And so that's the number of folks, this comes out on a monthly basis, the number of jobs that are being created. The green line there is the headline number. The dashed line there is the 3-month moving average. This graph is somewhat distorted. If you think about what we went through in March of 2020, you can see the rapid loss of jobs and then those jobs coming right back in the economy. What I'd really like you to take a look at, which I think is more salient given where we're at today, is the unemployment rate, which is on the right-hand side. And you can see the green line there is what we call the unemployment rate. And then the dashed line there is what we call the underemployment rate. What do I mean by underemployment rate? Those are those folks potentially that are working part-time that would like to be working full-time. So how they're being utilized in the system, and are they truly being utilized that way? What you can see is a very steep increase in the unemployment rate. And what we've seen more recently is that has come down, the unemployment rate, both the underemployment rate and the unemployment rate. Notice that we're still above pre-pandemic levels. So we have lower levels of employment right now, or higher levels of unemployment. But I do think that we'll continue to see that come down, given the fact that we are seeing the easing of restrictions, in particular here in California. The governor has told us in June 15th, I think, is really where we might see even a substantial restrictions lifted. And so with that, we'll continue to see that unemployment picture look better because we'll start to see restaurants and other types of industries who have been hurt by this start to open up in a more meaningful way. Looking at page 6, this is looking at initial jobless claims. This was really more informative at the beginning of the pandemic. What I really want you to take away from here is this is looking at the weekly initial jobless claims. These are people that are really focused on looking for unemployment benefits. So basically they're claiming unemployment benefits because they're out of work. And it comes out on a weekly basis. What you can see is the most recent one that we have in this graph here is of April 2nd. There's about 744,000. If we looked when we were kind of humming back a couple of years ago, basically we would look at that number and be 200,000 to 300,000. So you can see that that's still elevated. But what I really want you to really look at is the trend of the gray line above. And so that is those outstanding or continuing unemployment claims, and those continue to move downward. And so that is really the path and the trend. And we do expect that to continue as we move forward through this pandemic. Then you can look on page 7, looking at gross domestic product. So this just tells you a story of what happened in 2020. We'll get more numbers coming out probably towards the end of this month on looking at GDP. But what we're looking at here is the last 4 quarters. So if you look at March of 2020 in the table on the left-hand side, you can see June of 2020, September of 2020, and December of 2020. You can see the first 2 quarters were very weak, down around 5% and 31% respectively. And then the second 2 quarters, you saw an explosion relative to some of those lower levels. So 33.4 versus 4.3. You can see that on the graph on the right-hand side. And so you can see basically those green lines there represent those quarter-over-quarter changes. And then that maroon line there is the year-over-year change. Notice that that line there is around 3.5%. And that was the decline that we saw in 2020. But definitely we think that estimates for 2021 are around 6.4%. So definitely a recovery that's going to continue to take place. And also maybe we might see that a little bit more of that in the second quarter than we have seen in the first quarter, given that we did have some more restrictions that were on after the holiday season, as we saw a rise as an increase in cases that went on there. Moving forward here, you can see yields on page 8. And so you can see the dashed line there on the bottom is the 2-year note. The dotted line on the bottom is the 2-year note. The dashed line there is the 5-year note. And then the 10-year note, that's on the graph on the left-hand side, showing you a 2-year historical perspective on those. And that's that steeper yield curve that we talked about. You can see the dotted line didn't move very much, but if you look at the dashed line, which is the 5-year, and the green line, which is the 10-year, you saw that those moved higher. So that's that steepening yield curve. Short-term rates remaining relatively the same. That's where the Fed has the most influence. And then as you move further out the curve, basically the yield curve, that's supply and demand, inflation, some of those more macro factors that are taking place, and you're starting to see interest rates increase off of very, very low levels, I would say. And then you can see the yield curve that's on your right-hand side that shows the terms of the different bonds, and then also the yields on the left-hand axis there. And what you can see is the dotted line is March 2020. The dashed line is December 2020, and then March of 2020 is the green line. And again, you can see that steeper yield curve. Notice that rates haven't really moved 2 years out, but then as you go further out the yield curve, rates have started to increase over that period of time. And that's really the reopening of the economy and potentially some inflation expectations that have been increasing too, with just overall economic activity increasing. And along with that, the amount of stimulus that's been put into the system. We'll have to see, as far as inflation is concerned, whether those really come to fruition or not. Page 9 is just really looking at a broader look at financial markets. And what this is really looking at, this is a table. And really what we do here, we call this the periodic table of returns, almost like your chemistry chart. Remember that old chemistry chart with oxygen and gold and platinum, things like that. So what we do here is this table really is looking at different types of asset classes, and then we give them a color, and then we rank them year to year. And this goes back to 2011 all the way year to date. And really what I want you to focus on is A, what happened in 2020, and B, what's happening in 2021. Who would have thought that the stock market would rise or increase almost 20% in a lot of perspectives in 2020, given the pandemic. And then also what we've seen in 2021, the stock market continues to rise over that period of time. And so what you've really seen here, if you look at a broader financial picture, is that stock markets continue to increase. And a lot of that is really driven by speculation of better growth rates and better times ahead. Also low interest rates. Typically, when you get low interest rates, you are going to get a stock market where investors are going to look for higher returns, and a lot of times they're going to look for the stock market. We'll have to see how this ends up. One of the ways it is really, when you look at this, is when you look at some of the pension liabilities and things like that, is how are those pools of funds doing? And depending on how they're allocated, probably over the last couple of years, they've done very well. And also year to date, they're likely doing very well too. And so that's why I include this into the presentation. Then let's talk about your account. So let's look at the objectives, which is first safety, liquidity, and finally yield or return. And really our objective here on a performance basis is really to get a total return that is equal or above that of the benchmark over a market cycle. I would say a market cycle is 3 to 5 years is what I look at when I think about a market cycle. And then the strategy is really to hold high quality fixed income securities that are consistent with your investment policy and California government code. You can see the compliance of your portfolio. And really what I really want you to take away from here is that your portfolio fully complies with your investment policy and California government code. And you can see that also on the second page there.
I just wanted to mention real quick on this. This was one of the big selling points that attracted us to the Chandler product. Jason, maybe since we've got a new Director Aguilar here, you could mention briefly how your computerized model works for checking compliance.
Sure, I'll talk about our compliance process. So first and foremost, the best thing about a compliance process is you want your compliance process to be separate from that of the portfolio managers. And so compliance is a separate department. And so I am not doing compliance on the Coachella Valley Water District portfolio because that would not be a good control. So there is an independent office or arm of our firm that is the compliance department. And in order to really look at portfolios effectively, there's a lot of data that you have to look at. So if you think about credit ratings, maturity dates, issuers, where that particular security is issued. And so what we use is the Bloomberg AIM system. And the AIM system basically allows us to take the rules of your investment policy or any rule that we would like to put into the system. And basically on a pre-trade basis, before I actually transact the security, I put that into the system. The system evaluates the security based upon all of those rules and tells me if I can buy that security. If it does not, it will not allow me to buy it. And also on a post-trade basis. And so ratings of securities change on sometimes. And so in order to do that, we also have to do it on a post-trade basis. So every single day, your portfolio is run against the rules, and then it will basically tell us if there are any securities that are outside of compliance. If that were to happen, definitely we would go to staff and talk to staff about that in the portfolio. But definitely to have an electronic or computer-wise way of looking at all that data is the only way to go because there's a significant amount of data that goes into looking at that compliance of the portfolio.
Jason, this is Director Aguilar. Are there any exceptions to that model?
In what way?
In terms of testing your investment selections against this compliance model?
Yeah, so right now we do not have any securities that are outside of compliance in the portfolio. And it will look at the current day's ratings and things like that for all the securities. And so there are no securities that are outside of compliance.
Thank you.
Yeah, I really like that they created this as an individualized tool, client by client. This is for our investment policy. So I like the way their computer system is able to check all of the investments against our policy to make sure we are always in compliance. And we didn't always have that in the past.
Yeah, I agree.
Well, thank you. And I'll make sure to pass that on to our compliance area because sometimes they are the unsung heroes, right? As far as checking these different things. So we'll definitely make sure I pass that on to them. And then looking at your portfolio. So let's look at the portfolio characteristics. And this is as of March 31st, 2021. You can see your portfolio is actually in the center and the benchmark is that on the left-hand side there. And so focusing on your portfolio as of March 31st, the average maturity is 2.05. The average duration is 1.85. The average purchase yield is 1.43. The average market yield is 0.29. It's a AA plus rated portfolio, so a very high quality portfolio. And the portfolio's value is $373.9, almost $374 million. Now, if you look at the 12/31 date, you saw that it was $362 million. I wish I could tell you that we made $12 million for you over the last 3 months, but we were given additional funds to invest in the portfolio. So we always take that into account in our calculations and things like that. Then looking at the sector distribution, I'm going to focus really in on March 31st. These are the different sectors owned in the portfolio. So that what this tells you is really, are we using all those tools in our toolbox in order to achieve the goals of the district? So looking at the asset-backed securities, or ABS, those are 8.2% of the portfolio. Remember that these are securitized loans. As essentially, these are from auto dealers. So this could be from Toyota or Honda, things like that. So very, very high quality, AAA rated. But also we don't stop there. We look at the actual collateral that underlies those particular loans. So we have systems and tools in order to do that. Then US Treasuries make up 28.3%. You can see Supernationals 3.6%. Negotiable CDs are around 5% of the portfolio. Almost nothing in the money market. The reason that is because the money market is the lowest yielding investment. Actually, today you earn about 1 basis point on the money market funds. So we don't want to hold a whole lot of funds in there at this particular point in time. Corporates make up about 14.7%. CMOs, or collateralized mortgage obligations, make up about 5.8%. And agencies make up about 34.4%. One of the things that's happening in the market today, and you can see this from this graph, is that agency securities, the yield on those is almost right on top of treasuries. In some cases, treasuries actually have a higher yield than that. And so what you've seen is some of the assets have been gravitating over to US treasuries. The reason that that is happening is there's limited supply. That is by the agencies. More recently, they have not necessarily, Fannie Mae and Freddie Mac have not issued bonds since November of 2020. And so there's not a whole lot of supply out there. With that lack of supply, what happens is you get credit spreads tightening. And in general, credit spreads have been relatively tight. Credit spreads are the amount of interest that you earn over a comparable treasury security. The reason being is there's a lot of money out there looking for a home, i.e. that those higher yields and sometimes those corporate securities and those agency securities in the past provided a better yield than US treasuries. Since that time, that yield has shrunk. And so one of the themes, and it's not a very technical term, but I'll use it, is really we want to be very choosy about what we put into the portfolio. We don't necessarily just want to buy corporates for corporate's sake. We want to make sure that there's good value, there's good safety. And so we will continue to monitor the markets, include the agency where we believe it's appropriate, but also with agency securities, we probably won't see a lot of transactions actually purchasing those securities. Some of those have shifted over to US Treasury securities at this time. Here you can see on page 16, here you can see the assets with the different issuers that are out there. And really the main thing I want you to take away from here is if you look at the majority of the government securities make up the majority of the portfolio. So you have US Treasuries, you can see those agency securities. And then when we start to look at corporate securities, they're less than 2% of the portfolio. So we have a very well diversified portfolio that the district has today, really achieving those goals. One of the ways that you can get safety in your portfolio is, not put all your eggs in one basket. So basically diversification. And so we ensure that we have a diversified portfolio, but also looking towards those securities that will add value at the same time. And we do that by incorporating lots of different types of issuers that we believe have good value for the portfolio. You can see that also on page 17. And then you can look at the returns. So, our inception date is 9/30/2019. So getting close to 2 years here, not too far away, how time is flying here. And so you can see the graph above. You can see your portfolio in the green. The benchmark is that of the gray. And then you can see how we've performed over the last 3 months and 12 months. And also, if you think about one of those investments that a lot of public agencies use is LAIF. And so remember, LAIF is a very well-run pool in California, but also it's very short term, meaning its investments are relatively short. And so I want to put that as a benchmark just so that you can see how you're doing about a common investment vehicle that public agencies will use for their investment portfolios. And so you can see your portfolio over the last 3 months down 0.13% versus the benchmark, which was down 0.05. So a little bit worse than the benchmark there. But if you look over the last 12 months, we're 1.5% versus 0.95%. So around 55 basis points above the benchmark, or about 0.5%. And then if you look since inception, 2.53 versus 2.50. So if you look at that, about 3 basis points above that of the benchmark. If you look at LAIF, It increased actually over the last 3 months as we saw interest rates increase. It had a positive return of 10 basis points, but if you look over the last 12 months, it actually had a positive return of about 80 basis points, which is essentially half of what the district earned on its portfolio. And then also you can see that since inception, 1.20 versus 2.53%. So again, half. And also I would say that the LAIF is probably, the yield is going to continue to go down. LAIF is around 33 basis points now. Likely we're going to see that bottom out probably sub 20 basis points. I don't, that's kind of our forecast there. We'll see if that comes to fruition, and that will likely take another 3 months to see that come down there. But that's kind of where short-term securities are being issued. I showed you that a little bit earlier in the presentation.
Jason, I'd like to add another quick comment back there on LAIF. So, a lot of governmental agencies just tend to park all their money in LAIF. It's a very safe place to put your money, but it's also kind of a missed opportunity. It's so huge. I say it's like a barge on the ocean. It turns very slowly. And going back to Jason's discussion about diversity, yes, we're very well diversified. I think we have about 52 different investments on those 2 pages that he shows that we're in, but we're not over diversified. So I think it gives Chandler the opportunity to target specific investments to go into and to get out of proper time. I did notice you had Pfizer on the list. I meant to ask you, how long ago were you so wise to invest in Pfizer? But anyway, but I think that I'd asked Jason to start putting LAIF in there as a comparison. To me, that since inception thing is really where our eyes should be gravitating every single meeting. This is probably the best evidence to me of how we're doing since, the ICE BML is, okay, it's intuitive to experts like Jason, but not so much people like me. But LAIF I get a lot more. So this tells me that we're really getting our money's worth and seeing that over time we've been doubling the LAIF performance. That's it.
Jeff, I did have a quick question. Jason, I did hear you mention that it sounds like we just gave you more money for the portfolio. And I wanted to hear more about whether we do that on a schedule or what is the process or what needs to happen for us to give you more money for the portfolio.
Well, I'll just chime in. Maybe Carrie will want to add something, but it's basically on a cash flow basis. Our cash flows don't come in on a smooth basis. When we look at things like property tax payments, they come in big chunks, and it doesn't align well with our cash flow needs. Now, I'll also remind the board that this year's budget that we're in the midst of had a planned spend down of reserves of about $20 million. So as we are executing at a pretty high percentage on our CIP, in addition to the normal pretty high execution rate of the operating budget, that combined is leading us to have more situations of actually drawing down on cash in the portfolio rather than putting money in. But it's a constant balancing act as we're looking at our upcoming cash payment needs. And again, it's highly influenced by those capital project expenditures and versus what is coming in from our various revenue sources. Carrie, did you have anything to add on that? Or?
So that's correct, Director Estrada. So we do monitor our cash balance on a daily basis. we project out our cash flow for the rest of the month, and actually we go throughout the rest of the year. And so we work closely with Chandler to provide them the information so that they can invest our funds appropriately, whether it's going to be on a long-term or a short-term basis. So that recent deposit is just based on property tax receipts that we got in December. And we had a little bit of a slowdown of the expenditure and capital spending the first 3 months. So we had that extra cash that we're anticipating to spend before the end of June. So that's why there's that huge opportunity for us to send it over to Chandler to go ahead and take advantage of investing it, even on a 1 year or so.
So do we do this? So do we do this check like on a quarterly basis or?
It's daily. We are looking at on a basically daily basis where our cash is, and then focus on the accounts payable payments that are in the queue. And of course, we know what our payroll is going to be every 2 weeks. So those factors together are looked at against our expected cash flows on what we're expecting to come in from normal revenue sources such as water sales, but also property taxes and other items that are somewhat more scheduled as to when those monies are going to flow through.
Mm-hmm. Okay, thank you.
You're welcome.
Okay, we'll move forward from here. This gives you a little bit of what we've been doing as far as transactions. So you can see the purchases, the sales. We've had a couple of calls of securities, and then also we had some maturities. Really, the purchases have been focused, like I said before, in treasury and corporate securities. Typically, when we're looking at corporate securities, we are participating in the new issue market when a new issue comes. And why do we do that? Really, we get better pricing when we do that for those securities. So in order to borrow funds, typically, and the amount of funds, typically those securities will be a little bit cheaper at the new issue, and then they'll get a little bit richer or more expensive. And so that's where we have been purchasing corporate securities. Some of those have been in those new issues. And then we also are consulting with staff on an ongoing basis on liquidity needs and things like that to ensure that we have enough liquidity in the portfolio to really achieve the goals of the district related to projects and things like that. And the next few pages are just supplemental information. I didn't want to necessarily go through this information, but definitely you can go through this on your own. So it shows you a little bit more statistics on the portfolio, and then also it will show you any of the individual holdings in the portfolio. And at this point, I can definitely open it up to any questions that you may have. And I'm also going to stop sharing my screen.
Thank you, Jason. I just had 2 questions. Actually, one that's already been answered. Director Estrada, thank you for asking the question about the $12 million. I have the same request, but staff answered that very well. So appreciate that. So my other question is, do the benchmarks change, or are they static, or against which our investment performance is evaluated? How are the benchmarks actually set?
So what we do is we define that in the investment policy. So that's predetermined, meaning that we're setting that with staff. And as part of that evaluation, we look at a benchmark that has a kind of the same risk return profile, liquidity profile, things like that of the district. Once it's preset in the policy, basically the benchmarks do change as far as the number of securities that are in that benchmark based upon the rules that are part of that benchmark. So for instance, in your benchmark, it will only have securities in there with maturities between 1 and 3 years. And it also has to have corporate securities in there that are either A or better. So the benchmarks are dynamic as far as the securities that are within them, but the rules are set in place beforehand. And then also the benchmark that we choose, or we collaborate with staff before a benchmark is chosen for the specific portfolio. And depending upon what happens with the goals and also what the district is trying to achieve, we definitely can change that benchmark too, depending upon what's happening there.
Jeff, do those benchmarks ever come to the board for disclosure?
Well, they are, each time we reaffirm the investment policy. And from time to time, we do ask the investment advisors, whether it be Chandler or previously PFM, is this still a valid benchmark? Because what we're trying to do is not just select a benchmark where our consultants can win, say, we're doing better in the benchmark, but and Jason can probably say this better than I can, but the attempt is to try and get a benchmark that is reasonably comparable to our own investment policy parameters, not necessarily the same investments, but same kinds of investments, same duration of the investments and whatnot. Am I saying that right, Jason?
Yes.
So maybe you can comment a little bit more, other than the 1 to 3 year maturity range. Why is this benchmark an appropriate benchmark for us?
Sure. So if we think about, let's think about a couple of things. So depending upon what the liquidity requirements are, that really dictates what we want to do as far as looking at the maturity spectrum of that benchmark. So if you look at the average maturity of this benchmark, it's about 2 years. Given where you have different projects and things like that, it kind of fit within that. The other piece of that is to look at the different sectors that make up that benchmark. So your investable universe includes treasuries, agencies, corporate securities, and other types of securities. And so what we try to do is mimic that or match that the best that we possibly can. There's no absolute benchmark that will directly match your investment policy. But if you look at that benchmark, it includes treasuries, agencies, and corporate securities, which your portfolio does own. Now we have some other types of securities that we purchase into the portfolio, but those have same characteristics of kind of how a corporate security would look at itself during different market cycles. The other piece of that to look at is that also we try to look at the types of corporate securities that you can purchase. So instead of buying or having a benchmark that would include securities that were rated all the way from AAA to BBB, which is not appropriate for your portfolio, nor would it comply with California Government Code or your policy, we look for benchmarks that have similar ratings requirements. And so if you look at your benchmark, it says AAA to A. If you read your investment policy, that is exactly what the ratings categories are that you can purchase or the district can purchase, and also that conforms with California Government Code. So there's kind of 3 things that we look at when we're looking at appropriateness. We look at our client's ability, what their risk return profile is and the liquidity profile. We look at your investment policy, and then also we look to whatever that governing law is that's governing your investments. In this case, it's California Government Code, and the main section there is 53601 of California Government Code.
Thank you. It's very helpful. I appreciate it.
Any other questions?
So I'll just say that really the bulk of the rest of this is just specific transaction information. And usually we don't go through that. If there was something in particular the board was interested in inquiring about, we could look at that. But pretty much this covers the presentation at this point, unless there are any additional questions. Okay. Well, thank you, Jason. Thank you, Mia.
Thank you.
Good job.
Very
And
much.
So now, I'm sorry?
Oh, thank you very much.
Thank you.
Thank you.
So you guys can feel free to stay on if you want, as we're going to switch over, and I'm going to introduce Darren Hodge, our financial advisor from PFM, who has been doing a fantastic job for us as our financial advisor. He's going to go through a brief update of our efforts with the OASIS bond and just give you a little more insight what's happening with that. Darren?
Thank you, Jeff. Can everyone hear me?
Yes.
Yes.
Perfect. Well, good afternoon, and thank you for inviting me to speak today. We have been in front of the committee a few times over the past several months talking about updates to the Oasis project bond financing, and also talking about where we stand currently in the schedule and the steps that we have previously taken, and perhaps most importantly, next steps. So what I want to do today is just review kind of the timeline of events getting us to today, and then touch upon where we currently stand, and then highlight some of the key next steps just to make sure it's at the forefront of our minds. And obviously, directors, more than happy to answer any questions that you might have. So when we look back at when we really kicked this off, the transaction itself started back in November of last year in 2020. And it began with a creation of an underwriter RFP. And so the underwriter RFP was to select the underwriter who will ultimately sell our bonds into the market. That process ran through January of 2021, at which time an underwriter was selected. And we officially kicked off the transaction in February of 2021. And from February, March through about early April, we really focused on working on legal structure of the bonds, of the East Whitewater replenishment bonds, making sure that it was sufficient for marketing purposes. It was credit worthy, so that when we go to get ratings, we can secure strong ratings, which hopefully should equate to low borrowing costs. And that arrived us at the middle of April, and April 13th, that's when the board and corporation approved the legal documents. And so the legal documents included the resolutions, the trust, or the supplemental indenture, et cetera, kind of the governing documents around the bonds we're trying to sell, also governing the repayment and security that you will be providing bondholders. From there, the next step that we had was really finalizing what we call the preliminary official statement. The preliminary official statement is the key marketing document that we use to go out and market and solicit interest for the district's bonds when it's posted. And we've been working on that, and we'll be submitting that to the board and corporation for approval on May 13th. And that's in anticipation of, yes.
I'm sorry. Yeah. Would you like me to share my screen on your little calendar item?
Sure, if you'd like to.
Yeah, hold on. Because as you're talking through this, it might be useful for the board members to see it.
And so that really gets us to board approval, which is slated for May 25th. And so at the May 25th board meeting, what you will have in front of you for review and potentially approval is that preliminary official statement, our key marketing document. And what the preliminary official statement is going to include is all the pertinent information that a reasonable investor would need and want to make an informed investment decision. And so it's going to describe the security of the bonds. It's going to talk about the district, the East Whitewater Replenishment Fund. It will talk about the Oasis project and provide all the information, again, that a reasonable investor would want to know to make an investment decision. Assuming that we receive approval at May 25th, what that would set us in line for is to then be in place to post the preliminary official statement. And by post, what we mean is essentially publish it to the market. And that would occur the week of June 7th. And then ultimately price the week of June 14th, which would set us up for a close before the end of our fiscal year. So the one thing I do want to point out is that approval on May 25th, that is very important, because if we do not receive approval at that board meeting, that would obviously push back the timeline in our schedule. So that meeting is important to make sure that we have the board members there. I just went through a lot on schedule, so before I talk a little bit further, I'll pause there and see if there's any questions.
I have no question.
I'll just mention that something that kind of is between the lines here. And when we look at the week of May 10th, which is just next week, where the preliminary official statement has been finalized and it's loaded into the SIRE system for presentation on the 25th. And then you see submit documents to Standard & Poor's. So that's going to happen that week. And then down on the week of May 31st, you see receive the ratings. Well, the part that's lost here is the effort that went on several months ago, and a rather significant effort by all the team of these people down here. Were various members of these teams were involved in the discussions with S&P for indicative rating that we're still at the point where we're not able to speak about as far as the details of the outcome of it. But S&P's been looking at our agency for quite a while now. There's been a lot of work behind the scenes to educate them on our organization and the East Replenishment Fund in particular, and nuances regarding our financial plan. So I don't know if you want to say anything else, Darren, or you may be cringing I even brought up the topic.
No, it was a good point because there has been a significant amount of work that's gone on, to Jeff's point, by the entire working group. And I think what Jeff missed there is really by him and his team. Between him, Carrie, and David, there has been a lot of effort put into kind of the back end work, or the front end work, if that's a better way to describe it, to get this transaction ready to sell. And often it's difficult to describe just how much effort goes into it, but suffice it to say it's hundreds of hours. And so I think we're in a very good spot now where we are ready to enter the market. And right now the market is very favorable for utility credits like the districts. And so we are anxious to get into the market. And we ran some preliminary numbers. And if we were to sell bonds in today's market, we're estimating that our interest cost, our overall aggregate true interest cost, as we call it, would be in the low 3%. So what that means is that for 30-year debt, you're borrowing at a rate of 3%, which historically is a very attractive rate. And so that's really the goal at the end of the day, is to get that low cost of financing that really kind of allows you to flow that through to the ratepayers to keep the cost as low as possible.
Thank you, Darren. I think that's pretty much it, unless there are any other questions on the Oasis bond.
Jeff, I have a question. When the bonds are sold, are those proceeds then deposited with Chandler for investment, or are they kept separate until they need to be expended, or how does that work?
Darren, do you want to go ahead and describe that process?
Yeah, of course. So when the proceeds are issued, effectively, you have the option of how you want those funds invested. We worked with Mia and Jason in making sure that what we call the permitted investments language, essentially the definitions that govern what types of investments you are able to invest those proceeds into, were kind of in line with your policies, up to market standards, and obviously compliance with state law. And so at that point, you kind of have the option of how that money's invested, whether you want Chandler Asset Management to govern that, or you'd like to cover it. You have the flexibility depending on what you deem most advantageous. I would say one thing that we obviously want to be cognizant of is that the proceeds that we get, we do have a construction spend or estimates of when those funds might be needed. And so that's something that Jeff and his team will work with Mia and Jason on, in terms of making sure that those proceeds are available and that they're placed in securities that maintain their value, so that when we need those for construction, they'll be available.
Great, thank you.
And that timeline has been holding firm, that we're expecting the project to be completed by the end of calendar 22. So there's not going to be a lot of opportunity for any kind of investment of these funds. We're spending it pretty fast.
Okay, good.
But we also, as I mentioned before, we're going to be recovering monies that we've already spent as part of this process.
Thank you.
It'll help replenish the East Replenishment Fund a bit. No pun intended. So if there are no other questions, I'll just mention, we've been trying to do these meetings on a quarterly basis every 3 months. If we were to look ahead, that puts us in the first half of August. I just, not asking for an answer, but thought about, if there's a preference to meet in August or wait until September. There's no obligation for us to meet any particular time, but just want to put that out there for your thought now. And I know Sylvia will be reaching out to you in due course to start to set that meeting date. There's no urgency, but just want to mention that. One other thing is, we haven't forgotten about our follow-up to you from our last special meeting regarding the miscellaneous fee study implementation, and Carrie's been working on getting that response to you. Our plan is to simply email you information and look for feedback, and if you want to have a separate meeting, we can certainly do that. And that's all that I have. Anything else from the board members?
No, thank you very much. Very productive.
Okay.
Okay, so then
Well,
I guess
thank
we
you.
can officially adjourn, Jeff, that you have nothing else to present?
Nothing else. If Vice President Estrada has a gavel, he can feel free to use it right now.
I'm good. I'll wait for I'll wait for Sylvia's email regarding August or September.
Yeah, she has a couple of things on her plate, so you may not get it right away.
And thank you for at least letting us know where we're at with the miscellaneous fees. I know that at least I had some questions related to some of those charges, and I know that you were working on those, so I was wondering where they were at, but you've
Well, we weren't-
mentioned it.
We weren't done creating our information set for you, and we didn't want to send you a partial. So that's why we didn't put it on this agenda.
Okay, well, thank you. I don't have any other questions.
Okay,
Thanks, everybody.
Thank you.
Or
all right, thank you.
Bye-bye.
thank
Bye
you.
now.
Thanks, Jeff.